All right, what's going on, everybody? My name is Kenneth Beard here with Stock Indices, and today this video is going to be titled "How to Trade Options for Steady Cash Flow." So today I'm going to basically be explaining to you all, how I trade my options, the best way to optimize options in the more cash flow consistent way. A lot of new traders that get into options, they think there's only one type of way to trade options. They don't really know that there are multiple different types of ways that you can trade options. There's multiple different strategies that you can really master to just be more on a consistent side with options rather than on the buy side all the time. So today, let me go over just some of my thoughts on that and some things that you could do differently to turn your portfolio into a cash generating ATM basically. So this is Stock Indices. My name is Kenneth Beard. I run Stock Indices, and I will be doing whenever you see a video like this, any type of tutorial type of video, any type of breakdown video is going to be by me, Kenneth Beard. So going on with this, common mistakes new option buyers make: buying options deep out of the money instead of buying far in the money, deep in the money options. This can be a lottery play sometimes, because a lot of times what new option traders do is they see a very good opportunity in a stock. They see a good opportunity and to capture, it looks good. You could potentially pay a low premium for a deep out of the money contract. Let's say maybe 40 cents because you're 50 points out of the money. You can get these cheap contracts, but what they don't know is that this is essentially a lottery play, because there is, and this is leading into the next point. There are lots of variables working against the buyer, and unless you're going to be 100% correct on your assumption in the right amount of time, you have a lot of variables working against you as far as theta, gamma, and vega. These are all important factors, right? These are all important factors that most new option traders kind of dismiss, and it was something that I dismissed as well when I first started trading options, and it got me into a lot of trouble. So when trading options and when buying options, when you're buying these options instead, you want to buy them deep in the money. The reason why you want to buy these options deep in the money is because they have a higher delta, and that delta is going to match up with each dollar move. So, and I'm going to explain delta a little bit later in this video, but basically, when you're buying these deep out of the money contracts, you're not essentially getting the full move for each dollar move that the stock is going. And so it's really difficult to have a correct assumption depending on how much time you have left, and what happens with the implied volatility within your trade. A lot of factors can damage the trade when buying deep out the money contracts, which is with most new option traders the mistake. That's the main mistake I see new options traders making. So buying those deep out of the money contracts it can work from time to time, but for the most part, when it comes to being consistent and just trying to choose a direction, and this leads into the third point here: being completely directional based with options can lead to inconsistency. It's not impossible with good technical analysis and position sizing and risk management. I should have put that in there too. It's not completely impossible to trade with buying options, but you have to really understand the time frame and understand the factors that are working against you, which most new option traders don't. They don't understand this, and being completely directional based can sometimes lose and most of the time will lose to lead to a loss because of those variables working against you. So those are like the three main points that new options traders make, new option buyers, to be exact. So today I'm gonna be going over what is a put credit spread, and this is one of my favorite strategies because I've seen a ton of consistency with the put credit spread, and this is what I like to call the cash flow approach. Excuse me. High probability trade with lower potential of profit. So with the put credit spread, essentially what you're going to be doing is it's a multi-leg trade. So here you receive a net credit. It says this is a multi-leg trade where you sell out the money contracts with a high delta simultaneously with another deep out the money lower delta. So when you go ahead and write that contract, that short strike, you want that short strike to have more value. That way you receive a net credit. And here's the next point: creates a net credit. The strike you wrote has more premium value, resorting to a net premium received. So you get a net premium received because essentially what they're going to do is they're going to subtract the two premiums from the long and the short. Well, from the short and the long, that's kind of how it's going to be subtracted, because the long has more value. So they subtract those, and that's going to essentially be your net credit. You receive the net credit when you simultaneously put together that spread. And when you put together that spread, the max profit is the net credit received. The max loss is the difference between the prices minus the net credit received. So it's the difference between the strike prices minus the net credit received. So you have a $10 strike price. You're going to take that and subtract the net credit received. It's going to give you your max loss based on how many contracts you have. Now, how do you realize max profit? Well, max profit is realized when the trade ends above your strike price at expiration. So essentially what you want to happen is you want the trade to stay above your short strike. You want it to expire. You want both legs to expire worthless. In that case, you keep the net credit received. So what are the benefits of a put credit spread? It blocks out all the extra market noise. You can generate more consistent cash flow. So with all the extra market noise, I remember when I don't know if any of you watching this can relate to this, but when I first started trading options, and I was going with the fast scalp approach, when I would get in and get out, it didn't work for me because it was a lot of market noise. And my position size was off. I was going in with heavy size, trying to catch a little 20 cent, 30 cent increment within 3 to 2 minutes. A lot of market noise, a lot of pump fakes and things of that nature, which can really scare you out of trades and leads to inconsistency. It generates more consistent cash flow. With put credit spreads, you're having higher probabilities. You have higher probabilities of success. The reason why you have higher probabilities of success is because you're on the sales side. So you're betting against the buyer. You're betting against his theta. You're betting against his delta. You're betting against the buyer, essentially. So with you having those bets against the buyer, all the other factors that are working against the buyer are in your favor as a option seller. So it's a very good thing to have. And you can see your probability of success by looking at the deltas and by looking at the probability out the money, which is designed by the Black-Scholes model. You also get extra flexibility with adjustments. Now, I'm not going to get it all into adjustments as of right now. I'll get into that in later videos, but you can adjust your trades. Sometimes you can turn a losing trade into a winning trade that has more potential profit than the one that you first started off with. Now, that takes advanced skill, and I'm going to be, in my later videos, going over how to exactly do that. But those are just some of the things that you can do with put credit spreads and being an option seller. So, what are the odds? Like I said in my last slide, the delta shows essentially what the odds are. What odds are in your favor. The higher the delta, the higher chance your spread can end up in the money. Remember that. The higher the delta, the higher chance your spread can end up in the money. So always pay attention to the delta. It's going to really tell you what your probabilities are. Now here I have a picture of some deltas for some put options. Now you can see that these deltas are negative. And the reason why these deltas are negative is because when an option is increasing in value, well, when a stock is increasing in value, put options decrease in value. So for every dollar move up, you're going to have a negative delta. You're going to have cents taken out of your option. Value will be decreasing out of your option because put options make money on the way down. So that is why that delta is negative. Now when you sell a negative delta, when you sell a put option, it is the inverse. You make money on the way up. So that delta turns positive when you sell a put option. So the 220 strikes delta is showing a 34% chance of expiring in the money. The way I know that is because it says negative 0.34. That is showing us a negative 34, well, not take that's my fault. That is showing us a 34% chance of expiring the money. Also, right next to it, where you see the percentage, you can see the percentage chance of it staying out of the money, which is a 63.17% chance. So, like I said, it's showing how much that options premium will be decreasing every $1 increase in the stock's price. Let's keep that in mind. So there's a lot of things that you can look over, and really it gives you an edge. To me, I had no edge being an option buyer. And there was a lot of factors working against me, which led to inconsistency. When I found the put option strategy, the put credit spread strategy, I seen a major turnaround. And this is what I'm trying to stress to you all. So I'm going to show you all how exactly you can place a put credit spread. So this is Google. These are the option chain for Google here. And I'm going to go ahead and do a put credit spread for Google. So what you want to do is you want to find whatever, let's go do, I usually do around 36 delta. This is 24 days out. So this is going to give us $48.40 worth of premium for our short strike. So you always want to choose, like I said, you always want to choose the option as your short leg with the most value. So we go here. This is think or swim, by the way. You see here at the 36 delta, we're going to go here to sell vertical. And what you want to do is, you can see here, it pulls up to simultaneous trade. So both of them are going to be sold at the same, well, both of them, one's going to be bought and one's going to be sold at the same exact time. You can see here that this strike has more value at 22.05, and the long is further out of the money at 2,200, giving us a $1.75 credit. And here you can see what our max profit is, what our max loss is, and then the break even point. So that's kind of how I do it on Thinkorswim, and how I place those trades with the put credit spread. And after that, you just sit back and wait for the trade to work. And it's really that simple, you know. And if you have to do adjustments or anything like that, you can, which I haven't went over yet, but like I said, I will. But pretty much that's all it is to understanding these put credit spreads. Very optimal and useful strategy. And I really appreciate this strategy. It's worked for me plenty of times. So I suggest that you guys go ahead and do some more research in it. I will make more videos on call credit spreads and on the Greeks and things of that nature to really get you guys to fully understand how to, do these things. Leave a comment, like, and subscribe. This is Stock Indices, and I will see you all in the next one. Thank you for tuning in.